In a move that could have sweeping implications for the global economy, the United States Federal Reserve is gearing up to reduce interest rates. But what does this mean for you, the economy, and the world at large? The Federal Reserve, often referred to as the Fed, is the central bank of the United States. Its primary role is to manage the nation's monetary policy, which includes setting interest rates. These rates influence everything from how much you pay for a mortgage to how much businesses invest in new projects. Over the past year, economic pressures, including inflation and slowing growth, have led to increased scrutiny of the Fed's policies. Facing signs of economic slowdown and concerns over deflation, the Federal Reserve has signaled a possible rate cut. This decision is aimed at stimulating economic activity by making borrowing cheaper, encouraging spending and investment. However, the move isn't without its risks, as it could lead to increased inflation or financial market instability. A reduction in interest rates could have widespread effects. For consumers, it might mean lower rates on loans and mortgages, giving them more spending power. Businesses could benefit from cheaper credit, allowing for expansion and innovation. However, savers might see lower returns on their investments, and there's always the risk that too much easy money could fuel inflation. The Fed's decision doesn't just affect the United States. Global markets closely watch U.S. interest rates. A cut could lead to a weaker dollar, impacting international trade and causing ripple effects in economies around the world. Countries with currencies tied to the dollar or heavy reliance on U.S. trade may find themselves needing to adjust their own economic policies. The move to cut rates has sparked a debate among economists and policymakers. Some argue it's necessary to prevent a recession, while others believe it could lead to long-term economic instability. The Fed is caught in a balancing act stimulating the economy without overheating it. As the Federal Reserve prepares to adjust rates, all eyes are on what comes next. Will this decision provide the economic boost many hope for, or will it lead to unintended consequences? One thing is certain: the impacts of this move will be felt far and wide, from Main Street to Wall Street, and beyond. To understand the significance of this rate cut, it's helpful to look back at history. The Federal Reserve has used rate cuts as a tool to combat economic downturns in the past. For instance, during the 2008 financial crisis, the Fed slashed interest rates to near zero in an effort to stimulate the economy and avoid a prolonged recession. While these actions helped stabilize financial markets and support recovery, they also set the stage for years of low interest rates, which some argue contributed to the buildup of economic imbalances. The upcoming rate cut is part of this ongoing narrative, with lessons learned from the past guiding today's decisions. The Fed's decision is not just an economic event, it's also a political one. Politicians from both sides of the aisle have weighed in on the rate cut, with some praising it as a necessary step to protect jobs and stimulate growth, while others warn it could be a sign of deeper economic troubles ahead. Meanwhile, the public's reaction has been mixed. Some see the potential for lower borrowing costs as a positive, while others are concerned about what it might mean for their savings and long-term financial security. Social media has become a battleground for these discussions, reflecting the deep concerns and hopes of Americans from all walks of life. The long-term implications of a rate cut are complex and multifaceted. On one hand, lower interest rates could support continued economic expansion, helping to extend the current cycle of growth. Businesses may find it easier to invest in new projects, and consumers could see lower costs for loans and mortgages. On the other hand, there's a risk that this move could lead to higher inflation down the line, eroding purchasing power and potentially forcing the Fed to reverse course in the future. Furthermore, sustained low interest rates could encourage excessive risk-taking in financial markets, possibly setting the stage for a future instability. So, what should you do to prepare for this change? For consumers, it might be a good time to refinance existing loans or consider taking out new ones while rates are low. Businesses should evaluate their investment strategies and consider how lower borrowing costs could benefit their operations. Investors, on the other hand, should stay vigilant, as markets may become more volatile in response to this policy shift. Diversifying portfolios and seeking expert advice could be key to navigating the uncertain waters ahead. While the Federal Reserve's rate cut is a powerful tool, how it impacts you will depend on the decisions you make in response to this new economic landscape. One of the most immediate areas where a rate cut could have a significant impact is the housing market. Lower interest rates often lead to lower mortgage rates, making home ownership more affordable for many Americans. This could spur increased demand for homes, potentially driving up prices in competitive markets. For those already in the market, refinancing might become an attractive option, allowing homeowners to reduce their monthly payments or pay off their loans faster. However, there's a flip side if home prices rise too quickly. It could lead to affordability issues, particularly for first-time buyers who are already struggling to enter the market. Interest rates also have a direct impact on employment. When borrowing costs are lower, companies are more likely to invest in expansion, which can lead to job creation. This is particularly important in sectors like manufacturing, construction, and retail, where growth often depends on consumer demand and business investment. As businesses take advantage of cheaper credit, they may hire more workers, potentially reducing unemployment rates. However, if the rate cut fails to stimulate enough economic activity, or if inflation rises, it could lead to a different scenario where businesses struggle to maintain profitability, putting jobs at risk. Financial markets are highly sensitive to changes in interest rates, and a rate cut by the Federal Reserve is no exception. Lower interest rates generally make equities more attractive as the returns on safer investments, like bonds, decrease. This could lead to a rally in the stock market, with investors seeking higher returns in more volatile assets. However, the reaction might not be universally positive. If the rate cut is seen as a sign of economic weakness, markets could become jittery, leading to increased volatility. Investors will need to carefully assess the Fed's intentions and the broader economic context to navigate these turbulent waters. The Federal Reserve's actions reverberate far beyond U.S. borders. A rate cut can influence global capital flows, currency exchange rates, and trade dynamics. For example, a weaker dollar resulting from lower interest rates could make U.S. exports more competitive, benefiting American manufacturers. However, it could also strain relationships with trading partners who might see their currencies strengthen, making their exports more expensive. Moreover, countries with economies closely tied to the U.S. might find themselves forced to adjust their own monetary policies to maintain economic stability. The Fed's decisions are a key factor in the intricate web of global economic relations, influencing everything from trade balances to geopolitical strategies. While a rate cut can provide relief to borrowers, it can be challenging for savers and retirees who rely on interest income from savings accounts and fixed income investments. As interest rates decrease, the returns on these low-risk savings options often shrink, potentially impacting those who depend on this income for their daily expenses. Retirees, in particular, may need to reassess their financial strategies, possibly looking for higher yield alternatives, which could involve taking on more risk. It's a delicate balance protecting your savings while ensuring sufficient income in a low interest rate environment. As the Federal Reserve navigates these challenging economic times, its role continues to evolve. The Fed's decisions are not made in isolation, but are part of a broader strategy to maintain economic stability and growth. Moving forward, the Fed will need to carefully monitor the effects of this rate cut and be prepared to adjust its policies as necessary. This might include further rate adjustments, implementing quantitative easing, or other unconventional monetary tools if the economy requires additional support. The Fed's actions are closely watched by markets, policymakers, and the public, making each decision critical in shaping the future economic landscape. Public sentiment plays a crucial role in the effectiveness of monetary policy. A rate cut can influence how people feel about the economy, whether they're optimistic about the future or concerned about potential downturns. Consumer confidence is key to economic growth. When people feel secure in their financial prospects, they're more likely to spend, invest, and take on new financial commitments. Conversely, if the public perceives the rate cut as a sign of economic trouble, it could lead to a reduction in spending and investment, dampening the intended stimulative effects. The Federal Reserve must therefore not only implement effective policies, but also communicate them in a way that maintains or boosts public confidence. Looking ahead, the future remains uncertain, with multiple factors at play that could influence the economy's trajectory. Economists and market analysts have varying predictions about the long-term effects of the Federal Reserve's rate cuts. Some foresee a period of sustained economic growth, driven by increased consumer and business spending. Others warn of potential risks, such as asset bubbles or rising inflation. The global economic environment, political developments, and unexpected shocks could all alter the course of events. As we move forward, staying informed and adaptable will be crucial for navigating whatever lies ahead. Stay tuned as we continue to track this developing story and its implications. For more Global Finance Unlocked, don't forget to smash the like button, subscribe button, and the bell to receive a notification every time a new video is posted.